With Sai Life Sciences, the fact that TPG Asia has exited this particular pharma company, selling their entire residual stake. Let's chat a little bit more. We've got Krishna Kanumuri, the MD and CEO at Sai Life Sciences, joining in on the show right now. Mr. Kanumuri, morning. Thank you so much for your time today on ET Now. I first want to talk about this TPG exit. How does life
Okay,
change?
sure. Look, I think nothing changes, right? TPG has been invested for the last 8 years. They've been not on the board for the last 6 months. And look, as long as their private equity goes, I think they're past their cycle. They've been invested for 7 years. I think it's the right time for them to exit. And I think this is, and look, we have nothing to do with capital market transactions. We are business of running a growth company, and they've not been involved in the company for the last 6 months. So I think we don't really have to comment on it, but they've been a great partner. They've been supporting us for the last 7 years, and I think it's been a good relationship. I'm glad they made a good exit.
Mr. Kanumuri, hi, morning. The company has been scaling as a leading CRDMO organization. Where are you seeing the strongest growth? Discovery services, development, or commercial manufacturing? And which segments are going to be the next growth levers for the company?
Look, I think we've been very different from traditional CDMOs. We are the only end-to-end player in India. We operate everything from discovery to development to commercial manufacturing, whereas most of other companies are very focused on one or two, either discovery or late-stage commercial manufacturing. And because we have end-to-end breadth, I think we've been growing across all three areas. I don't think there's any one area which I can come and say is a laggard. All three of them are extremely strong, and they fit very well together because customers want to work with one-stop shops. I think that is really what has caused us to continue to grow, continue to add relationships both in small and large pharma. So I think our strategy is very differentiated, and we don't necessarily focus on the shorter term wins. We focus on really building the long-term sustainable business models which can compete with the best in the world, be it with the Chinese or the Europeans. We really invest in technology, invest in people, and take a very long-term view on the business to add long-term investor value as well as customer value from that standpoint.
Hi, morning, Mr. Kanumuri. This is Shrishti also joining in. But the biggest overhang for the pharma space remains to be the tariff right now. Anything in your space where you feel that the tariffs can really make an impact, or is that already started to do so, given the exposure in the international markets?
See, I think the tariff part is not going to be a huge issue. Just given the fact of the matter is that majority of these supplies are from India and China. So I think if you look at what Europe and US focus on, they focus on advanced, maybe some GMP stages. Pharma does them in-house. And right now, most of the advanced intermediates, both GMP and non-GMP, come from India and China. And what would likely change with the tariff scenario is in the longer term, some of the supplies we send to Singapore and Europe to the existing manufacturing facilities of large pharma will shift to the US. So from that standpoint, I think we are going to be long-term neutral in terms of the tariff impact. Short term, there'll be noises, so on and so forth. But so far, no customer has come back and said tariffs is an issue. I think because also if you look at 80% of the work we do or 70% of the work we do is R&D, which is generally going to be exempt from tariff for the long term. And the commercial aspects are 3-4 years out. And what pharma is more concerned about is not concerned about the markup on their raw materials. They're much more concerned about their most favored nation clause. And I think the cost of the intermediates we supply relative to the final product is still marginal enough, will not make a big difference in terms of the long-term strategy. Because Europe and US just don't have the capacity to do the back-end intermediates nor the speed to support this. So there will be a lot of noise, but I don't see long-term impacts yet, specific to CRDMO business going forward. At least that's the premise, but it's evolving world. Right now, things look business as usual.
Okay, good to hear that. So, Krishna, leave us with what your revenue CAGR outlook is for the next 3 to 5 years. Markets want to know that
Look,
number.
we've always consistently maintained the 15-20% CAGR over a 3 to 5 year period. This inherently a very lumpy business. So for us to, we might have a phenomenal year this year, next year might be muted. But one thing we consistently tell the market is we are working in an inherently cyclical industry because clinical programs die, commercial programs don't succeed. So we cannot have a straight line growth factor as the market changes because our customers themselves don't have a straight line growth factor. So it's not a generic business where you have launches, you can predict it. This is going to be a lot of it depends on uh, our customers, how trends change. You hear about going to GLP-1s, you hear about going to immunology drugs, oncology drugs, ADCs. So as technologies change, people change, our pipeline is going to continue to fluctuate. So it's very hard to predict annual growth rates, but over a long period of time, we feel very bullish about our growth rates. 15-20% is a good measure to take forward.
Okay. Krishna, great to hear that. And thank you so much once again for talking to us today.
Thank you. Thanks for having me. Have a good one.